Hi guys, welcome to another episode of Finance Talk, where we speak about finance, business, and investing. I'm Eugene. I have more than 10 years of experience in business. I also interested in finance and building my own portfolio and hoping to set up a fund in the nearest future.
And I'm Nick Rational. I too have a lot of business experience and been doing the investing for a while now. Together, we're going to share with you what we have learned, and together we can all learn more and become greater investors. I too hope to start a fund in the near future, and let's all learn together.
So what will be our today's topic, Nick?
All right, so I would say a good topic for today would be why stocks, and also why is it that money managers can't beat the market. There's been studies that have shown that 95% of money managers can't beat the S&P 500 in performance. And so I thought we'd discuss about that today. I saw a study a while back, and I'm going to just say the figures off the top of my head, but they're probably very close to accurate. I can't cite the exact study because I'm driving and I'm just thinking about it. But it's pretty accurate what I remember. And what it is they did a study looking at various things that people consider to be good investments. And they looked at if you put $1 into that investment 200 years ago and you just left it alone, and the average rate of growth of that thing, where would you be 200 years later? And what they found was the dollar, if you just did nothing with it, would now be worth around 10 cents. So it lost 90% of its value. So if you're not investing your money does go down really quickly. We've discussed in a previous episode about inflation, how your spending power goes down. And that's what the study shows quite clearly. 90% of value is lost in that time. The next thing they looked at was property, and $1 in property 200 years ago would have yielded $250 now. And as you know, that's a lot of return. It's pretty good. People get excited about property, but that's not very good when you compare it to other things. For example, gold over 200 years has gone from $1 to $300. Bonds have gone from $1 to $1,500, which is staggeringly better than the others. And yet it looks like nothing when you compare it to stocks. If you put $1 into the stock market as a whole, 200 years ago, $1 would have become $1 million today. And that shows very clearly that the winner by far in growth is stocks. What do you think of that study? Quite mind-blowing?
Yeah, I also read about this study and was quite fascinated about that. But I think that when we speak about the comparison between stocks and different asset classes, it needs to be pointed out that not every business is a long-term compounder, as we will talk about in next episodes. Probably and usually people compare S&P 500, so they're with the top 500 companies of the particular country with the different asset classes, because when you invest in such type of security, you do not choose one particular company. You choose the broad list of them. In this case, you and we as a value investors, we do not try to time the market. We just try to invest our money as better as we can.
Absolutely right. When we choose the stocks, we do a lot better than the S&P 500 if we're doing our job correctly. That study, though, which showed $1 becoming $1 million, that was just put into the S&P 500. There was no stock choices or anything like that. It was just the market as a whole compounded the money to that degree over 200 years. We can do a lot better than that, but it does show that stocks perform as a asset class better than other asset classes.
We as value investors, we try to be more concentrated in the limited amount of stocks. For example, 5, 10, 15 positions, not broadly diversify. And we choose our positions really carefully. So in this case, we can achieve much higher returns in comparison to S&P 500, because index is just the average sum of the work result of a lot of companies. If we compare the results with popular hedge fund managers and hedge funds, you can see quite different situations. And you actually can see that most hedge funds don't beat the market and actually don't beat the S&P 500. And why is that?
I've got a whole lot of different reasons that the 95% of money managers do not outperform the market, and we're going to cover them one at a time. So the first thing that stops these huge hedge fund and money manager people from beating the S&P 500, they should, in my opinion, mostly all lose their jobs, because if you can make more money just by putting your money into the S&P 500, if you can make more money doing that, why should they even exist? And I'm sure there's a few of them that can underperform the market and should still exist. For example, if they're offering significantly less risk than the market, and you're, in your retirement years, and you can't afford the risk of the market because you might need that money in the next 5 to 10 years, maybe they should exist. The first reason is that when you're managing other people's money, you have something called third-party pressure. And to explain that, imagine you're a baseball player and your job is to hit those balls. And when us investors, value investors, we can sit in cash and we can wait for that perfect pitch. We can wait for the perfect ball that's going to grow our capital. We can just wait. We can let all the offers go past us. But when you're managing other people's money, they're all there in the bleachers and they're watching you and they're saying, "You're not doing your job. You need to swing, you bum." That's what they're saying, because they want to see you do action. So there's a huge amount of pressure for you to actually do trades all the time, pretty much. And you even if there's no deals, you need to. The third party pressure is tremendous to take action. What do you think of that point?
Yeah, I definitely agree, because most people you interact and work with, they do not know all these principles about value investing, and they think that, okay, you can just buy the stock at $100 and you can get 120 in 1 month, and it is perfectly for them. But in value investing, it doesn't work like that. So we actually get paid if you are real and you would like to be a great value investor. You are get paid by the results and the less actions which you take, because in this case you are not tightened with the tax and all this stuff. You're not tightened with this pressure. You're not tightened with choosing the wrong companies, because when you have the deadlines, you need to decide quickly. But in most cases, the great value investing denies that.
Absolutely right. And you bring up a good point about often the great returns that these fund managers could have had are eaten away by the fact that they're doing so many trades. The more trades you do, the more taxable events you have. You're subject to much worse taxes if you don't hold the stock for over a year. And every trade obviously has a cost of doing that trade. There's different fees and stuff, and there's also the spread. So effectively, you're whittling away, and then of course they charge their fees on top of it. You lose a lot of the returns you could have had. Plus, of course, they're doing subpar deals because they need to be doing deals all the time, while we just wait for the really big deal.
You lose not only the potential returns, but you pay more commissions to the broker as well. And if you can just compound all these losses for 20, 30 years, this can be the substantial numbers, because these guys usually manage 100+ million portfolios or even billions.
Huge money indeed. And a lot of these funds are charging 2% management fee, even if they lose half your money that year or 10% of your money that year. They still get to take 2% of the total amount as payment, which I think is disgusting. I personally will never charge a management fee for any of my funds that I start. That is a promise. Hold me to it. I don't believe in the management fee. I want to get paid on performance, not on going to the beach and having a good time and just letting your funds do whatever. So let's move on to the next reason that they are underperforming the market. The next one is called institutional imperative, and that is another reason that they're underperforming. And what institutional imperative is, in layman's terms, I would say is monkey see, monkey do. they're being compared to their peers. So if they're making a certain return and the guy next to them is making more, even a small amount, they might even lose their job, or people will pull their money out of their fund. And so the institutional imperative isn't to perform as best as you can. It isn't to buy the best companies. It's to do what the guy next to you is doing. It's to perform as well as the guys around you. You don't want to take any risks that could have you underperform them even for one quarter. So institutional imperative is that you're going to do basically what everyone else is doing because you're afraid of losing your job or of losing the money in your fund. That's a terrible, terrible thing. What do you think, Eugene?
That's why most value investors like Warren Buffett, Guy Spier, Manish Pabrai, they can just go away those crowd cities where people just compete with each other, and you feel this competitive spirit. And this competitive spirit is also like the mental trick which your mind plays with you, because it hurries you up, and you need to pick the first company which you think is better and will perform better in the short term. And usually you need a lot more time in order to analyze the company, analyze the management, talk to other people, just read the reports, press releases. In this case, you do not need such time. So you need to perform in a hurry way. And usually this is the way most people just make the mistakes. We as value investors, we can go against the crowd. So if there are other people just selling shares of particular company, we need to look deep and understand, is this company really undervalued or overvalued? And what is the real reason they're selling it? And if they just sell because other guy from work wants to earn more money and they also want cash out, we just shouldn't do that as well.
I like what you said there. There's two points that I want to pull out from there that lead us into our next point. The first thing what you said was doing different to the crowd is what benefits us a lot of the time. Being a contrarian, not just doing the opposite for opposite's sake, but doing the opposite because everyone else is just following the crowd, and we're doing the research and seeing what is actually the most rational move. And so that's absolutely right what you said there. And then the other thing you mentioned a lot was time. We have different time horizons to these other people, and that's the next thing on our list. It is time horizon, and what that is that if you're a money manager, you are judged quarterly on your results. If you have even a few, like 2 or 3 bad quarters, your investors will pull their money out, or you'll lose your job, or both. And so effectively, they have to work on a short time horizon. They have to follow the market or beat the market in the short term. And short term really makes you invest with both hands tied behind your back. There's a lot of reasons that it harms you. One of which is that it's practically impossible to really predict what is going to happen to a company in the short term. A single quarter in the business world, anything could happen. But if you understand your company, you can go with reasonable certainty, they're going to grow a certain amount in the next 2 or 3 years. They're still going to be here. I've looked at the figures and I understand this company. But can I tell you what they're going to have for earnings a quarter from now with any reasonable certainty? No. And so they're working really difficultly with their time horizon, while our time horizon is a lot longer. Your thoughts, Eugene?
Yeah, and another reason why most fund managers can lose some money in the short term, and we as all value investors can benefit from the long-term perspective, is that, so for example, you want to set up a new retail store, but in order to do that, you need 2 months or 3 months to find the right location. You need 1 or 2 months in order to deliver all the technical stuff and all the machines there. You need another 1 or 2 months to order the goods and set this whole thing up. In general, you need approximately 1.5 years in order to just set up the new location. And if you do, and if you think only short term, you cannot achieve so much, because even though the company has a great plans, they cannot execute it in 1 or 2 months, but they can do it in 1 or 2 years easily. So that's why most investors can benefit long term, and short term gains usually can be dramatically bad for the investors.
Absolutely. I remembered something we talked about earlier in this episode, and that's actually deserves to be a point all on its own. Misaligned objectives. When you look at like somebody who makes sales in a business, like a car company, and he sells cars, to align his objectives correctly with what the company needs. They incentivize him by saying, yeah, okay, you've got a base salary, but the majority of your money is going to come from sales, commission, and that's aligning the incentives correctly. He's really motivated to make those sales, which is the most important metric of his job. So that's aligning your incentives, aligning your objectives. Now, these money managers, they don't really, most of them care so much about their performance, because while a lot of them do get paid on performance as well, a lot of their money is based on the size of the amount of money that they're managing. It's called assets under management, AUM, and that's the most important thing to them, really. The more money that they manage, the more money that they make, and it's not because of performance; it's because of that money management fee. That management fee of 2% I talked about earlier. 2% of 100 million is very different to 2% of 200 million or 400 million. And so what they really care about is how much money are they managing. And so their incentive is to have as much money under management as possible. So if they do something like do a 3-year bet on a stock that is definitely going to double in 3 years, fantastic return. But they have 3 or 4 bad quarters, half of their fund could disappear, and they don't want that. And so they don't take those long-term bets, and we call it bets, but it's actually not gambling. It's making a rational decision based on reward and risk. So effectively, because of money under management, their incentives are misaligned, and therefore their actions are all about having as much money under management and not all about performance. And so basically that's one of the big reasons I think that they underperform the market. Your thoughts?
When you setting up the fund or work with different funds, you need as an investor look at the fund structure. And to me personally, and also the Nick, when we work with the investors, we receive our bonuses or our benefits from the total result of the fund. So when the fund actually makes the money, we also make the money. But we do not collect any management fee, for example, like 1 or 2% yearly based on just managing the assets. This structure is similar to Buffett partnerships, which he set up in early 1960s. So he just put the structure 0.625.
Exactly. The 0 in the 0.625 means zero management fee, which I approve of a lot. And then 6% is the hurdle that he has to give to the investor before he makes any money. And then thereafter, that's where he gets his performance fee. So that is a great structure. I like that a lot. I'm going to model my fund very similarly. I believe in giving my investors choices. And so I'll always have these 2 choices for people to choose between. That's something I like doing.
Okay, guys, this is the end of this particular episode, and we will continue for the second part next time. So please subscribe to stay tuned. And if you have any questions, please write them down in the comments, and we see you next time. Okay, guys, this is the end of this particular episode, and we will continue for the second part next time. So please subscribe to stay tuned. And if you have any questions, please write them down in the comments, and we see you next time.